Hello, this is Dan Perkins with Money in Motion video blog, and thanks for watching. As always, we need to look at our three indicators to see what's happening in the marketplace. Our first indicator is crude oil. As you can see by this chart, crude oil has declined from its high and seems to be trending lower, indicating there is less and less demand for energy. Therefore, supply is starting to build and prices will fall. The next item is gold. As you can see from this chart, gold is $1,157 and has been trending down for the first almost 7 months of the year. I don't see gold going anywhere soon. There doesn't seem to be any concern in the world about hyperinflation, and the markets, even though they've been extremely volatile, do not see any significant recession that would cause a rush to gold. The last leg of our stool of things that we watch is interest rates. And what we see here is that interest rates have risen dramatically over the last almost year, approaching now the 240 basis points level. I would anticipate the market will have some resistance at 2.5%, but given the momentum and the desire for the markets to want the Fed to increase short-term rates, I expect to see pressure continue on the 10-year yields. In addition, the movement of the volatility in China and the possibility of general global slowdown, I think would not put much pressure on interest rates from this level. The last thing we want to look at is the dollar-euro relationship. With all the controversy in Greece and what's been happening between them and the central banks of Europe. Right now we're at about $1.10. Some people think that it may go down to $1 for dollar later this summer. Perhaps if Greece has problems, it may break $1, and we'll just have to wait and see. We do have to be concerned that there are other states, nation states, Italy, Portugal, and Ireland, who are in similar straits in terms of their GDP to debt ratio to Greece, and may in fact be in difficulty and may need bailouts from the European government and the bankers. The last thing I want to talk about is the volatility of the American markets. As this chart shows, the S&P 500 has been all over the place for the first almost 7 months of the year. I expect this volatility, as I've warned in previous calls, to continue. We are not developing what I consider a very attractive chart pattern. So I expect the volatility to continue, and I'm in no great hurry to spend cash that we might have in our portfolios. And I know we have a lot, but I'm looking for the best time to invest until things settle down a little bit and we get a clearer picture of what's going on. There's just too much risk to make any significant investments at this moment in time. I'd rather stay put where we are, have a lot of cash, and look for buying opportunities like we did earlier in the year when things came down way too fast. So that's all I have at the moment. As always, if you have questions, please feel free to give me a call or send me an email. And thanks for watching.